high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest in the banking space. Today is 29th of June 2023. I am Ruchika Chitravanshi, and first, a look into what we have in store for you today. Our cover story will talk about the vacant chairman posts in public sector banks. In Banker's View, we have Naveen Tahilyani, MD and CEO of Tata AIA Life. What are the RBI's riot relief measures? Watch our Banking for You segment to find out. Our expert take with Tamal Bandhopadhyay today talks about the EdTech loans, credit card default, and the recent MPC meeting. At the end of the show, we will share the results of last week's poll and the question for this week. In India's public sector banks, a concerning void persists, despite the Reserve Bank of India's persistent emphasis on the importance of sound governance. 6 out of 11 public sector banks find themselves without a non-executive chairman. Even more disconcerting is the fact that some of these crucial positions have remained vacant for over 2 years. Ayush Mishra finds out why chairman posts are vacant in so many public sector banks.
At a time when the Reserve Bank of India has been emphasizing the need for governance in commercial banks, 6 of the 11 public sector banks still do not have a non-executive chairman. Some of these positions have been lying vacant for more than 2 years now. The concern was raised during the RBI governor's interaction with the board members of public sector banks last month. The UCO Bank, Bank of Maharashtra, Bank of India, Indian Overseas Bank, Indian Bank, and the Central Bank of India are functioning without a non-executive chairman. In fact, the Bank of Maharashtra and UCO Bank never had a part-time chairman since the separation of the chairman and managing director positions commenced in 2015. During his keynote address, RBI Governor Shaktikanta Das compared the role of a bank chairperson to that of a ship's captain. He stressed the importance of their experience, competencies, and personal qualities in navigating board discussions and ensuring effective decision-making.
When the RBI governor is saying a chairperson of a bank is akin to a captain of a ship, it's ironic that so many chairperson posts in banks are vacant, that too for a long time. If you don't appoint a chairperson in public sector bank, then the entire objective of splitting the chairman and managing director post is defeated. The larger issue is that of governance reforms in public sector banks. The PJ Nayak committee, which was formed to look into the governance issues in banks, submitted its reports in May 2014. The report suggested that the government should distance itself from the appointment of board members and that board members should be empowered to make those appointments. That has not happened so far.
Governor Das also underscored the crucial responsibility of bank boards in providing clear and consistent direction to the banks they govern. Sriram Subramanian of advisory firm InGovern explains the impact of a vacant chairman position on a bank's performance, safety, and profitability.
I don't think there is any immediate impact on the bank's performance or safety or profitability, because that is for the executive team to execute and under the direction of the board. But at the end of the day, it is more a message or a signal that is sent to investors at large that corporate governance norms require a chairperson be there in any listed company. And significantly, when the government is a large shareholder, not having a chairperson is a huge negative signal to investors at large.
A majority stake in public sector banks is owned by the government. So how can the government fix this vacancy conundrum?
See, this is a problem with the government itself. The bureaucracy or the finance ministry under whose this one authority the public sector banks come should take proactive measures to put in people to fill these vacancies, right? Of course, there's a banking selection board, etc., etc. Those are procedures. But at the end of the day, this is a message which the government is also sending to the world at large, and that is a negative message. So the government can, if it makes up its mind, the bureaucrats there in the Finmin should take proactive measures to fill these vacancies.
As the public sector banks continue to navigate these challenges, it remains imperative for the government and RBI to collaborate and fill the vacancies in key leadership positions.
While some experts feel there is no immediate impact on safety and profitability, the government must move fast to fill these posts. To use the RBI governor's metaphor, a ship cannot be left without a captain for too long. In our next segment, Business Standard's Manojit Saha caught up with Naveen Tahiliani, MD and CEO of Tata AIA Life. Tahiliani talked about product innovation and how the company has seen record growth and also higher market share. Here's the chat.
Hello and welcome to the Business Standard Banking Show. Tata AIA Life Insurance recently declared its highest ever bonus of rupees 1183 crore for participating policyholders for the financial year FY23. The bonus in FY23 is up by 37% as compared to the previous year. Naveen Tahilani, MD and CEO of Tata AIA Life Insurance, is with us today. We'll talk about the company's performance and the future strategies. Mr. Tahilani, welcome to the show.
Thank you. My pleasure to be here.
Tata AIA Life is the sixth largest private sector life insurance company in terms of the IRDA data on new business premium. There has been a steady growth in the recent years. What has been the strategy that has led to this growth?
So, firstly, I would just like to clarify that when you look at new business, we are a player which is very focused on retail business. And within retail, when you look at the annualized premium equivalent, last year was a very good year for us where we had about 60% growth on retail APE, and we were number 3 in the industry. And in fact, we are the only non-bank owned player in the top 5 on this metric. What is driving this growth, to your question, or what is driving this market position of number 3? I think first and foremost, we are a very protection focused player. And on protection, we have done some innovations on product in particular. But again, as per IRDA published data on retail sum assured, which is a measure of the quantum of protection that we are writing, Tata AIA was number 1 in the private sector with a 27% market share in the private sector.
Right.
And product innovation, focus on protection is driving our overall growth, where while we are number 1 in protection, we are overall number 3, as I mentioned. Second thing I think is we are very focused on some of our consumer metrics. It's quite important that every sale is a right sale for us. And that metric is something that we are very proud of. In fact, we are more proud of that metric than our growth of 60% last year. Because when you look at persistency data, which is now also published and available in the public domain, you will see that in the 13th, 21st, 25th, 37th, and 49th month cohorts, we are actually number 1 in the industry. And on the 61st month cohort, which is the 5th year renewal premium, we are number 2 in the industry. So when you take a kind of overall blended look, we are very proud of the fact that our renewal quality is the best in the industry.
Right.
The third thing I would say is, we've been working very hard to improve our consumer experience at every point of the customer's interaction with us. Claim settlement, which is what life insurance companies are here for. I think first, we are here to protect the customer.
Right.
And second, we are here to, pay the claims when the time arises.
Correct.
Last year, FY23 was a landmark year for us where we crossed 99% claim settlement ratio on the retail front.
Why do you think that this year could be slightly tougher than the previous one?
I think 2 reasons. It's more mathematical than anything else. The underlying
Base effect,
opportunity. It's, if you look at last year and you look at industry data on the retail side in particular, you will find industry grew at about 19% on retail APE. But when you break it up, it's a story of 2 quarters, quarter one and quarter four. Quarter four, there was a bit of a bonanza for the industry given the change in the tax regime, which was anticipated. And the industry showed very, very strong growth in quarter four. And when you look at quarter one, which was April, May, June of fiscal year 23, there was very strong growth because quarter one of the previous year was the COVID Delta wave. So the industry had, kind of had a very tough time in that quarter the year before. I think after a long time, we have a regulator who is very dynamic, very focused on the developmental aspect of the industry, very constructive, very collaborative, working very closely with the industry to understand pain points and debottleneck them, while obviously maintaining the balance of making sure that we continue to be a well-regulated sector. So I think some of the regulatory tailwinds, in addition to the structural opportunity, will definitely continue to power growth over the next 3 to 5 years.
Is an IPO is in the sight?
No, not really at this moment. I think, unless IRDA mandates that companies of a certain scale and size need to list, we have no immediate plans to list. The reason being pretty straightforward, that we are very well capitalized. Our solvency ratio is more than adequate at this moment. And should we need capital, I think both our shareholders, Tata Group as well as AIA Group, are very committed to injecting that capital. So there is no reason to go to market to raise capital.
You talked about your agency force. Now the IRDA new regulations gives some flexibility to the insurance companies on commission. Will you offer a higher commission to agents and other distributors?
So first, again, this is a sign of the progression and the focus on the development agenda within the IRDA, which I was talking about earlier, that now there is more flexibility on creating commission structures. I don't think this will result necessarily in higher commissions. Our approach is a little different. Given that we have this commission flexibility, what we are trying to do is make sure that for certain products which are good for the consumer, we are able to offer higher commission there. I'll give you a very specific example. Pension products. Earlier, the commissions were capped at 7.5%. Now, as part of this commission flexibility, we can increase the commission. We have, in fact, increased the commission on pension products already. And, that is a good product for our agents to take to the customers. So that is one change that we have brought in. Second, as I was saying, because we are very focused on renewal and quality of sale, we will look to link more and more of the commission of our agents or distributors to quality of renewals that they bring, or to the quality of assets under management. If I look at things like, unit-linked products, which we don't sell much of. Like last year, unit-linked was less than 20% of our total premium, new business premium. But, you can kind of incentivize distributors now to make sure that they encourage customers to stay on for longer in the unit-linked product. So some of those changes of linking commission to renewal performance, to assets under management kind of performance, and selectively tweaking commission in products like pension or some aspects of protection is what we will do. But very excited about this change, because while these may sound like minor changes, what I'm talking about, when you look at the impact of all of these on the quality of our business and the growth it can bring, it is very, very material. And this is something, we and I'm sure the entire industry is actually very thankful to the IRDA for.
So on that note, thank you, Mr. Tailani, for speaking to Business Standard. It was a pleasure talking to you.
Likewise, the pleasure was all mine. Thank you.
The Manipur government has declared that riots and violence in the state have impacted the economic activities and livelihood of most of the general public. The government has decided to invoke the RBI's riot relief measures in the state. But what are these measures? Raghav Agarwal explains.
Manipur has been on the boil since May 3rd. As security forces grapple with containing the situation, the Manipur government has invoked the Reserve Bank of India relief measures by banks in areas affected by natural calamities, Directions 2018 in the region. The guidelines are related to providing relief measures in the areas affected by natural calamities and disturbances. Chapter 7 of RBI's relief measures pertains to riots and disturbances. It stipulates that whenever RBI advises the banks to extend rehabilitation assistance to individuals affected by riot or disturbance, the guidelines must be followed by banks. The guidelines outline several norms that must be followed for restructuring the loans, providing fresh loans, and other measures, including KYC norms. According to the directions, all short-term loans, except those overdue at the time of the riots, are eligible for restructuring. The principal amount of the short-term loan, as well as interest due for repayment in the year of occurrence of riots, must be converted into a term loan. For crop loans, if the loss ranges from 33 to 50%, a maximum repayment period of up to 2 years should be allowed. If the crop loss is 50% or more, the repayment period may be extended to a maximum of 5 years. In all restructured loan accounts, a moratorium period of at least 1 year should be considered. Banks should also not insist on additional collateral security for such restructured loans. For long-term agricultural loans, existing term loan installments should be rescheduled according to the repaying capacity of the borrower and the nature of the rights. If only the crop for the year is damaged without harm to productive assets, banks may reschedule the payment of installments during the year of natural calamity or violence and extend the loan period by 1 year. The banks may also postpone the payment of interest by borrowers. But if productive assets are also damaged, a new loan may be necessary. For all other loans, the State Level Banking Committee or SLBC and District Consultative Committee or DCC must specify which loans need to be restructured. Based on their assessment, the loans will be restructured by individual banks. The decision to sanction fresh loans will also be based on the recommendation of SLBC or DCC. A sympathetic view must be taken while sanctioning new loans. Banks will assess the need and decide on the quantum of loans to be granted to the affected borrowers. Banks will take into consideration their credit requirement and the due procedure for sanctioning loans. Banks will also provide consumption loans up to 10,000 rupees to existing borrowers without collateral. Moreover, credit should not be denied for want of personal guarantees, and a fresh loan will be granted even if the value of security existing as well as the asset to be acquired from the new loan is less than the loan amount. For those who have lost their documents due to riots or calamities, banks are required to open new accounts. This will be applicable where the balance in the account does not exceed 50,000 rupees and the total credit in the account should not exceed 1 lakh rupees. The RBI has also instructed banks to render services in the affected areas by setting up satellite offices, extension counters, or mobile banking facilities. Additionally, due importance should be given to restoring the ATMs or making alternate arrangements to address the immediate cash requirement of the affected people.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
That is some timely intervention by the RBI. Coming up next, our in-house expert Tamal Bandhopadhyay tells us what he thinks is the key message in the minutes of the Monetary Policy Committee meeting. And also he talked about credit card defaults and HDFC's Cadilla success story in EdTech finance. Here's our chat. Hi Tamal, welcome again to the Business Standard Banking Show. I was reading your very interesting column you've written on Cadilla's success, and you've talked about the whole edtech loan sector, which is very interesting, very complex. And you've talked about how NPAs are on the rise in this sector. Now, can you put in context for us what is it that has made Cadilla a success, and what are the unique challenges of this particular sector?
Yeah, Cadilla is very different from others. As you rightly said, the NPA in the sector, I mean, you talk about banks and non-banks all put together. It's slightly dated number, but that's the available number, above 7%. But Cadilla, it's all along, even during the COVID time, it never touched 1%. Now, what's the difference between Cadilla and the rest of the sector? Cadilla is very different. It's actually modeled on the largest education lender in the USA. It's called Sallie Mae. That's it. So here, typically, if you find that Indian banks particularly, I mean, how they give the education loan. Of course, there is risk management, underwriting, etc. there. But so once I'm going overseas for a study, or even within India, going for higher studies or technical studies and all, I do apply for it. And I get the loan or I don't get the loan. But here is Cadilla, which is something very different. The entire appraisal process is very different. It weighs so many things, because there is so many variables, like my own personal caliber, how is the course. Once I get into the course and then I complete, what are the possibilities of job getting, what could be the salary in my new job, so on and so forth. So all these factors have been considered by Cadilla, and then there is no limit to what extent one can get the loan. And this loan is home delivered. So it's very different from others, and it's one relevant point. What I'm saying is there's an enormous possibility in this particular segment to go.
So moving on to something else that has been making news is the credit card dues. Credit card dues on the rise, default is on the rise, and we've had an RBI which has been cautioning banks about the retail lending as well. So how do you see this trend evolving, and how wary do you think banks need to be about these dues and defaults?
Just one data point I would like to highlight is this: in India, what's the credit card penetration? I know, can you guess? It's just 4.62%. 4.62% of Indians have credit card. Now, what's the comparative figure in Canada? It's 82.74%. In Israel is 79.05%. So ours is very, very low penetration, and in fact, Pakistan and neighboring Pakistan and Bangladesh is even lower. That's one story. Other story is what you are really saying is this. Yes, in the post-COVID world, we're seeing, I don't want to burden you with more data, that credit card dues are now, the hip is getting more. I mean, there's a swell in the credit card dues. This is the general story because, people losing jobs and everything else that has happened in the post-COVID world. Is there any sense of where is the regulator is a little worried about this happening? Yes, indeed, that we have seen the newspaper reports. And do we need to, does the bank need to do certain kind of soul searching, particularly in as far as the retail loan is concerned? What's going wrong? Yes, probably. As we speak, we find that there are certain cracks in the retail lending. Need not be worried terribly, but yes, there are certain kind of signs are there that things are not absolutely hunky-dory in the retail sector.
Talking of the things that are not all hunky-dory, the MPC minutes were out, and we have seen some divergent views there as well. What is the key message in the MPC meeting?
Well, yes, of course, there are not that every decision is not exactly unanimous. Every decision means there are two key decisions. One is that pressing the pause button, and the second is particularly when there is no unanimity is the carrying on with the stance, which is the withdrawal of accommodation. Now, why this withdrawal of accommodation stance continued? One of the reasons probably was this withdrawal of the 2,000 rupee notes, asking people to return the 2,000 rupee notes so that more money. And as we speak, governor has in a recent interview said that 2/3 of the loan of 3.6 trillion 2,000 rupee worth of loan, it's come back. So liquidity, when liquidity is back, if you Reserve Bank of India wants to continue with the withdrawal of accommodation, even though there's not exactly the unanimous or consensus decision on this. On the pause button, there is a consensus decision. And I must say the key takeaway is, and which is it's very heartening to see, that Reserve Bank of India is not celebrating the drop in inflation, because it is fully aware that the risks to inflation are still there, which is why the inflation for the year, its assessment projection for the current fiscal year has come down by just 10 basis points from 5.2 to 5.1. And RBI wants to see inflation at 4%, which is actually the target. If you see the flexible inflation targeting of Reserve Bank of India is 4% plus minus 2 percentage points, which means 2 to 6%. Now, the past 3 years, I would say, there was a general feeling that RBI is wavering from this 4% inflation target. And if it's happy, if it's 5% or 5% plus. And there are so many months it's gone beyond 6%, which is the upper end of the band. But now RBI has made it very clear, and in the MPC minutes also, it's pretty clear. And subsequently, RBI governor's interview in the media space is this: look, our inflation target is 4%. So what does it mean? A, RBI has not changed its inflation target, which many were like a little bit apprehensive that RBI would be happy even if its inflation is on the higher side, but less than 6%. That's not the case. RBI is sticking to this 4% inflation target. And second is, we can't expect no policy rate cut too soon, because unless RBI is absolutely sure is on the top of it and it has been able to bottle the inflation genie, RBI will not go for any rate cut.
Lots of important takeaways from our chat today, Tamal, whether it is the whole retail lending situation due to the rising lending rate, as well as the aggressiveness of banks. And yes, indeed, heartening to know that that RBI is not yet celebrating the decrease in inflation. And as you said, that it is not expected to cut the rate anytime soon, which you have said in the past as well. So thank you so much, Tamal, for joining us today. And we will be chatting with you again next week.
Thank you.
So RBI is set on the 4% inflation target. That was Tamal bringing us his insights into some of the key issues that made news in the banking sector. After that interesting chat, it is time for the results of our last week's poll. Here's what we asked you last week. Should compromise settlement be allowed for willful defaulters? 36% of our respondents said yes, while 64% said no. One news story that caught a lot of attention recently was the annual salary of the SBI chairman. There were comparisons with the private sector, where the bankers drew a much more handsome sum. Of course, the government job comes with its own perks, but you can tell us what you think. Here's our poll question for this week. Are public sector bank CEOs grossly underpaid compared to their private sector counterparts? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.